Good morning, everyone, and welcome to today's webinar, Investor Cash Flow Loans, or DSCR, for today's property investors. Now, throughout the webinar, I'm sure lots and lots of questions are going to come up. As they come up, please go ahead and type them in the little questions function. And what we're going to do is at the end, during the Q&A, we're going to have our panelists answer your questions for you. With that, I'm going to turn it over to today's speaker, Jeff Rosati. Take it away, Jeff.
All right, thank you, Rose, and good morning to those of you in the Mountain Time Zone and West, and good afternoon to those of you in the Central Time Zone East. As Rose mentioned, my name is Jeff Rosati. I'm a regional sales manager for LendSure Mortgage. I've been in the mortgage and finance industry roughly 20 years, and I cover several states in the western half of the U.S. I live in the beautiful Mile High city of Denver, Colorado, and you might expect me to say something like "Go Broncos," except I actually grew up in Minnesota for the first half of my life, and so I'm a huge Vikings fan. So those of you on the call that are from Chicago or Green Bay, your rates just went up by 100 basis points. Just kidding. So let's get into talking about what I'm going to talk about today. First of all, I will tell you a little bit about LendSure. I will go over why we think you should partner with us. Second, I will go over some investment property landscape in the community today, and then I'll cover some program specifics as well as address some scenarios and exception examples that we've been able to do with this product. And then, as Rose mentioned, we will open it up for questions and answers at the end. And I have our Director of Credit, Steve Moloff, that will help with that. So going into a little bit about LendSure, we were founded in 2015. We are headquartered in San Diego, California. We have a couple operation centers, one in Rhode Island and one in Atlanta, Georgia. We have a highly experienced non-QM management team. Most of us came through the subprime days back in the late 90s, early 2000s, so we are very experienced with these types of loans, and we are lending in 40 states and continue to expand there. So some of you on the call are already partnered with LendSure. Those of you that are not, I just want to run through a few bullet points on kind of how we operate and why we think you should partner with us. First of all, we're very flexible within our guidelines. So we make human decisions based on compensating factors to the files. If we believe a file is going to repay, we will try and lean forward on that loan. Typically, about 45% of the loans we fund are outside of our guidelines. So we pride ourselves on that, on knowing loans and being able to lean forward on deals that others possibly would not. We have a highly experienced AE staff, and they will assist in structuring and pricing your files to give you the best available options. Now, the AEs will ask you a lot of questions up front, and we do that to get the full story on the file to identify any pitfalls that we may not foresee down the road. So we want to address those up front, so that way you have the peace of mind throughout the process. So that upfront pre-qualification is very important to vet the files, sign off on any exceptions that we identify, so that way you can go back to your realtors or your clients with peace of mind that this thing is not going to hit some roadblocks down the 11th hour of the process. So that's something we do different that some other companies do not. And then we have set up regional specific operation teams that include pre-qual underwriters, and account managers that you can work with directly to build rapport and create efficiencies. We actually encourage you as a broker to speak with our pre-qual underwriters, again, to make sure we have that full story up front and to be able to put the best presentation on the file when we go to approve it. So that's some things that are a little bit different about how we operate than some others possibly in the market sector. And so we encourage you to work with us and get to know that process and experience how that works. So let's talk a little bit about what the investment property landscape looks like. According to Statista.com, there are over 43 million investment property units in the United States. So that's a big number. Kind of a fun fact and a visual for you to put it into perspective. If you had $1 for every one of those investment properties, so if you had $43 million and you stack those dollar bills end to end, if you started in Chicago, you would create a dollar bill trail all the way to Honolulu, Hawaii. So obviously we don't expect you to finance all 43 million of those properties. It would be very nice, but I just want to give you a visual on how vast that market sector is and the opportunity available to you in that market. So as most of you know, a lot of these properties are financed with hard money, and these loans are, quick to do, they're quick turn times, but they come with a cost. They have a short-term balloon note, typically 1 year. They have upfront points, sometimes 2 to 3 points up front, and they have high rates, normally north of 10%. And so the opportunity with this product we're going to describe today will allow you to not only refinance out of those deals out of their hard money loans, which I see typically 1 to 2 of those a week, but it also allows you to circumvent the hard money loan and get in ahead of the process to offer that client a longer amortization, lower points, and lower rates, so they don't have to look to refinance within a year and be able to buy those properties or refinance those properties without using the hard money option. So property investors typically have multiple properties in their portfolios. They continue to add to those, and if you can use this product, it should create a stream of purchase and refi opportunities for you to years to come as you work with these investors. So it kind of begs the question, where do I start, right? How do I locate these property investors? So I'll give you a few examples. So one, you could just Google local real estate investor associations. Pretty much every marketplace in the United States has these available, and you can look to align yourself with those associations and maybe attend some of their meetings. Another way is there's websites designed specifically for the investment community. And so one of the more popular ones is Bigger Pockets. And that actually allows you to network with real estate agents specializing in that market, the investment community. And then lastly, Facebook obviously has a huge number of participants, and there's a group section on Facebook that you can actually search. And so I am going to turn back over to Rose, our marketing manager, who's going to talk to you a little bit about that, how to use that Facebook search, and also will demonstrate or show you some examples of some marketing materials we have that are free to you to go out and go after this business. So Rose, I'll turn it back over to you to talk about Facebook.
Great, thanks so much, Jeff. So this is something that you guys can try right after the webinar. It's quick, it's easy, and it's a way to get involved with all of the investors in your community that are actively looking for solutions. So what you want to do is go to Facebook, in the little search function, go ahead and type in your city, your state, your metropolitan area, and then followed by the words property investors or property investment. And then when you get the search results, you're going to get search results for topics, posts, etc. Click on groups. That's cool. This is an actual search result. When I typed in San Diego property investment, and you can see San Diego Real Estate Investment Club, 630 potential customers, 158, 280, and this is just some of the results. So it's a really good and powerful way to get in front of these people by joining these groups, answering questions, and providing solutions for them when they're actively looking for them. And so if we provide you resources so that you don't have to just, make up your own. We have our private label resource kit that you can use. We provide you with banners for social media. We provide you even with postcards if you want to do a physical mailing, Outlook email templates so that you can do an outreach to your real estate partners and your realtors, and flyers so that you can print them up if you want to go network, and you have something there that you can customize with your logo and with your contact information. And we provide this for our investment properties. We also provide it for bank statement and foreign national. So we have these tools available to you. So that is the URL. And yes, you're going to be getting a copy of these slides, so you don't have to worry about writing it down right now. But these are available to you courtesy of Lehnsherr.
Perfect. All right. Thank you, Rose, for that. Now I'd like to just get into a little bit more about the nuts and bolts of the product, and that's probably what you guys are looking for mostly. So the DSCR stands for debt service coverage ratio. It's really just a simple mathematical equation that we look to calculate that ratio. And so this slide just kind of demonstrates how that works. It's basically you take your gross rents or the rents amounts that's provided by the appraiser on a 1007 for a single family property or a 216 for a multi-unit, and then you divide those rents by your principal, interest, tax, and insurance payment, and if there's any HOA, you would add it to that as well. And so that's pretty much it, just a simple divisor, but it basically breaks down to where it'll give you that ratio, and if your ratio is greater than 1, that means you are a positive cash flow, and that amount would cover the debt service. If you're less than 1, then you're a negative cash flow, and that would not. And so it's that simple. Currently, our guideline is a 1.25 ratio, but we will make exceptions down to 1, again, with compensating factors. And so just a quick math on that. So if your principal, interest, tax, and insurance payment was $1,000, you're going to need to have gross rents of at least $1,250 to get to that 1.25 number. So hopefully that makes sense. And you can always, contact your account executive to help you with, putting that together as well to get to that ratio to make sure you have a deal. So why would you use this product? The main reason is ease of use. So there's really no other income documents required. The ratio that we just went through, that is your income. All we need to do is complete a schedule of real estate for all the properties owned. You do not need mortgage ratings on all those other properties. So if someone has, 15 different investment properties, you do not need to chase down mortgage ratings on all those other properties. You also do not need to verify the taxes and insurance on all those other properties. What you need is just a complete 1003 with the employment section filled out, but leave the income section blank on page 2. There is no DTI requirement. As long as that ratio cash flows, again, at 1.25 or greater, or down to 1 on exception, that is what we use. So you can see for someone, especially with multiple properties, this is a very good tool to use, and doesn't take a lot of your time to put together. So it allows you to close multiple loans for the same investor at the same time. And these are fast closings with minimal conditions. 6 months ago, I think our record time with one of these loans was we closed it from start to finish in 4 days. So you can see we can compete with the hard money, quick turn times on these. All right, so moving into some parameters around the product. You guys need to kind of know what you're selling out there and what you can operate within. So on a purchase and rate and term refi, you are looking at a 70% LTV max currently. On a cash out refi, we will go to 65% loan to value. The loan amounts will go up to $750,000. And again, just like all of our product platform, if we have compensating factors, if we think we have the ability to repay on the loan, we will lean forward and make exceptions to that dollar amount. There's no limit to the number of properties one investor can own, and we can finance up to 10 properties for a single investor. We will allow non-warrantable condos, and we do this product as well on 2 to 4 unit properties. One huge factor with this product is that ratio we talked about. We can qualify that ratio on an interest-only payment, and we offer 2 separate options for interest-only. We have a 5-year and a 10-year IO, and those amortize out to 25 and 40 years, but that is excellent for qualifying to get that number down, to get that ratio up, and it's also great for your investor for cash flow purposes. So I have an example later on in the presentation that I'll go through that shows you the benefit of that IO payment. Okay, the next thing I want to run by you is these are our rate structures for our non-owner occupied properties, and this is based on a 740 FICO. And what I really wanted to highlight is I've demonstrated the ease of use of that DSCR product, and I really just wanted to mention that the margin or the spread between full doc and bank statements isn't very high. So if you can, we obviously want to try and give the consumer the best rate possible, but if you can go to the DSCR, you can see, like at a 70 LTV, the full doc is just, the DSCR rate is only less than 100 basis points higher than full doc, and a DSCR versus a bank statement is only just over 50 basis points higher. So the margin in the rate is very low for the ease of use of that product. And then I just wanted to mention that we will allow the DSCR calculation on our foreign national program. It does add 1 percentage point to the rate that's displayed here. So just so you know that, I just want to demonstrate that. One other unique feature that we do at Lehnsherr is that we allow what we call stacking on a loan, and we will allow that on up to 75%, but the max LTV on DSCR, like I spoke of, is 70. But I just wanted to highlight, put on display an example of what we could do with the rate structure if you have a borrower that's rate conscious and wants a lower rate than what your base rate you quoted. So in this example, we have a $400,000 loan amount. LTV is 70. If our base rate started at 7.25 and the borrower's like, that's too much, I can't do that rate, we have the option to finance in and buy that rate down. So it's a 2-to-1 ratio on the rate buy down. So if we went to get to 6.25, we would take 2 points, which would be 2% on 400,000. So that's $8,000. We would finance it into the loan. And so you'd start back at a $408,000 loan, but the borrower is going to get a 6 1/4 rate. And so pricing, everything remains the same in that 70 bucket, but they basically get a point less on the rate without having to bring in any liquid cash to make that happen. So again, unique feature that we allow, and again, you can leverage your account executive to go over those pricing options up front so that you can offer the best pricing to your client and hopefully lock the deal down. The next slide I wanted to go over is just basically what we do outside of what Fannie Mae guidelines are. So again, we have unlimited number of properties. Fannie Mae will allow 10. Fannie Mae has a 720 FICO cut to allow for multiple properties. We go down to a 680. Again, we allow non-warrantable condos where they do not. And we can also close these deals in an LLC name. So those are some things that hopefully expand your market and some deals that you can probably pick up that maybe you couldn't if you were just limited to the conforming world. So as I mentioned earlier, we do make a lot of exceptions. And so I just want to put on display a couple examples of some exceptions that we've made recently on this product. So I just pulled some deals out of our operating system, but you can see this first deal, our guideline maximum is $100,000 cash out. And this deal we approved to $200,000 cash out. And you can see we look at compensating factors. So this deal was a 40-year term, 10-year IO. Some great great parameters of it: 60 LTV, 745 FICO, mortgage paid as agreed for almost 70 months, a high DSCR ratio of 1.4. So we leaned forward on this deal and allowed 200,000 cash out outside of our $100,000 guideline. So again, if there's compensating factors, we will lean forward and step outside of what our guidelines say. A second example that I pulled, again, really strong profile here. We have the same thing, a 10-year IO, 40-year term, low LTV at 65, good mortgage history, strong DSCR ratio of 1.25, so right at our guideline minimum. And the exception on this one was that it was an age-restricted property, so we were able to get that approved by senior management. But again, just to reiterate, great compensating factors, we will step outside the guidelines. I mentioned earlier about the interest-only benefit and how that works and how you can use it to your advantage. So I'll show you a quick example of a deal. So this was a purchase, 720 FICO. You can see the parameters there: 350 purchase price, 60 LTV, 210 loan amount, rate at 6.75. So if you go through the parameters there, the total payment was 1730 against a rent of 2100 for the 1007. So if you take and do our math there, 2100 rents divided by the PITIA of 1730 gives you a 1.21 DSCR. So that would not qualify based on our current guideline. And again, we do exceptions, but if we bring that IO into play, so to add IO to this product, it's a quarter-point rate add. So now we go from 675 to 7, but our IO payment comes down to 1225 versus a fully amortized payment of 1362. So that takes our ratios now. We take the 2100 divided by our now 1593 PITIA, and we get to a 1.32 DSCR. So we're now above our 1.25 cut, and we're able to approve that deal. So that's just a quick example of how the IO can help you get over that hurdle and make a deal work where it might not if you could not use that IO to calculate the payment. So again, guidelines 1.25, we went on to 1 on exception basis with compensating factors. The next scenario I want to present is a actual live scenario from a pre-qual we had last week. We had a broker call in with 2 investment property duplexes, wanted cash out on both refis. So it was a 694 FICO, 60 LTV, was looking for 100 grand cash out on each. They called us because they could not take it Fannie Mae due to a 694 FICO. As I shown earlier, they need a 720 Fannie Mae. So we were able to do that deal, and so we went on to 680 in all those parts. So we were able to approve it where Fannie Mae was not. So as we get to the end here, I just want to wrap it up with a few parting comments. We are a sales culture. We pride ourselves on driving volume. We want to close a lot of your deals. We will help you structure them. We will fight for exceptions to get deals done. We want you to leverage our experienced AEs to help you assist in structuring those deals up front to help push those deals through. Once you learn the DSCR product, you'll begin to experience how fast and easy it is to use. You can close multiple loans at the same time and create ongoing relationships with these investors to add to your pipeline. And bottom line is we want to build a partnership with you to not only grow our business, to help you grow your business. And so that is it. And so with that, I am going to turn it back over to Rose. And again, we have Steve Moloff, our Director of Credit, on the line that will help answer any questions you have. So I'll turn it over to Steve and Rose.
Thank you, Jeff. Now, as a reminder, please go ahead and use the questions function to submit your questions. Can a borrower pay down 6 points to buy down the rate 3 points? So what would be the maximum that someone could buy down the rate?
I think the floor is a 6.25 currently, but once again, we can go outside our normal floor if we need to, if it's close on the right deal. we'll try to work that out with you.
Okay, great. Can you make loans on properties that will be used for Airbnb? If so, what info do you need to confirm the property income?
That's a good question. We see a lot more of that, obviously. We do have it in the guidelines that you can use Airbnb income as well as, VRBO. We normally like to see a 12-month history at the minimum that they've been using it in that capacity. So that is very possible, and it's pretty easy to get the printouts from them showing exactly what they collected for rent. So that happens quite often. In fact, we had another example too, just so you know, on a purchase in generally resort areas, obviously for these, we did get an appraiser to actually change his 1007 rent survey to include potential VRBO income or other daily income as part of that rental amount. So if it's on a purchase as well in a resort area, you might want to ask the appraiser if he's willing to do that for you.
Okay, great. We got a question about property types, specifically if 1 to 4 unit condos apply.
That's not a problem either. We do smaller unit condominiums. Typically on both coasts, we see a lot of those, especially here. We're in Southern California. It's very common to see lower unit condos. So wouldn't be opposed to that. It's all about getting a proper value. So not a problem.
Okay. When someone is buying a new investment property, do you go off the market rent schedule on the appraiser or the actual rental income?
That's a good question. If there's currently renters in the property and you have an assignment of rent, if it's going to expire, like a change right happening as the purchase, we can take a look to see the market rents if they're paying below. So that is an option. Another option we have too is if you're actually paying more rent than what the rental income is listed on the 216 or the 1007, if you can provide 2 months canceled checks with a lease, we will also go off that higher amount. So we have flexibility in there depending on the deal.
Does the investor program allow for first-time buyers?
Yes, it does.
Okay. What's the minimum loan amount?
Normally we go 150,000 across the board. I approved a loan yesterday for 100,000. We generally don't like to clip below that, but the 150,000 is the normal standard.
Okay. Is there a reserve requirement?
Yes, there is a reserve requirement. Once again, it depends on the deal. If we are short a few reserves, we can usually do that. We would like to look at the whole picture with these loans. So the standard is 6 months, but if we have an understanding, the cash flow is really good, he's owned the property for years, we will make deviations on any loan we look at if we believe it's a good loan for the borrower and they're going to pay us back. So 6 is a standard.
Do we make any exceptions for LTV with compensating factors?
Yes, we can. I don't know how much higher we'd go currently on a purchase on this program. Obviously, the higher the loan amount is and the higher the LTV, the harder it is to meet the debt service coverage ratio or the cash flow. So, but we will on the right deal. I never like to say no because sometimes I love the deal and we'll do it anyway. So, but generally we stick to the LTV on these deals, but we'll always look at a deviation if it makes sense.
Okay. When you say investment properties, do you mean 1 to 4 families, non-owner occupied properties, or could it be more units? What about mixed use properties?
Well, there's a couple questions there. So 1 to 4 units isn't a problem. Also, obviously condos, non-warrantable, Jeff mentioned those as well. So that's not an issue. The mixed use properties, we look at those case by case. Generally, we don't do them, but we have done them in the past. I've done probably a couple in the last few months. So it's not a definite no. It really depends on how the mixed use is, what percentage of the floor plan is mixed use, and if it's typical for the area, we can get appraised on a residential appraisal.
What about minimum FICOs for this program and the bank statement program?
Okay, well, the minimum FICO for the program we're looking at is 680. However, once again, depending on the deal, LTV, how long people have owned the property, strength of the borrower, reserves. We'll make exceptions on that. Same thing on the bank statement program.
Okay, great. And then, let's see, we do a couple on exceptions. I'm getting a bunch of different questions on whether the slides and the recording is going to be available. Yes, look for a thank you email in about an hour after the webinar stops, and that will include a link to the slide deck and a link to the recording. I'll also go ahead and include the link to the private label resources. Can you broker using an LLC, or do you have to be a licensed broker?
Sorry, Rose, you broke up just a hair on that. I didn't hear what was the first question.
Can we broker to use an LLC, or do we have to be a licensed broker?
We use comergence to approve our brokers, so I believe you have to be licensed in the state you're doing business in. If it's a more specific question, please send it in and we'll give it to our broker approval department.
Okay, does a DSCR investor have to own a primary residence?
No, we have been able to do those. Once again, it's kind of deviation. We normally like to see someone who's owned their primary residence, but that's what our guidelines state if you're a first-time investor. But once again, depending on the compensating factors, understanding the circumstance of where the borrower is currently living, obviously the highest risk on these, they have to be non-owner occupied. So that makes it a little bit more dicey if they're currently renting and buying in the same location they're living in.
Okay, what about foreign nationals and ITIN borrowers?
Foreign nationals, once again, it isn't a problem. We do a lot of foreign nationals, and they're available on the DSCR program as well. Currently, we don't have the ITIN program available, but we're hoping that changes as the market continues to level set.
How long does the lease agreement have to be in place for?
How long do lease agreements have to be in? Well, the lease agreements can be in place immediately. The question really becomes, is the amount on the lease agreement going to be supported by the 1007 or the 216 when we get that in? Like I said, if the lease agreement is actually higher than what the rents are, reasonable, and you get 2 months canceled checks, we'll take the higher lease amount.
Okay, and can we use future rental income to purchase to qualify?
Absolutely. Whatever that says on the 1007 or the 216, normally you're buying investment property. You're not going to want to sit there and leave it empty for any length of time. So yes, we certainly do that.
Okay, and for initial and ITIN, Airbnbs, forbearance. There's a question about forbearance, particularly now with the COVID-19. How will this affect the qualification process?
That's a good question. I actually got that question on another call this morning. So really have an understanding of why the customer took the forbearance. That's the key. Are they in the forbearance? Did they just start it? Can they get out of it? Normally, we don't want someone actively in a forbearance if they're doing a transaction with us because they're stating to their last lender that there was some kind of financial impact. So it's really having an understanding of what the reason was for the forbearance. I did one yesterday where Wells Fargo is handing these things out like popcorn. They're telling people it's not going to affect their credit. However, this one does show in Wells Fargo as a forbearance. So when the borrower found out about that, he was pretty upset that they reported anything on the credit because they told him they were not. So we take those case by case. Once again, having an understanding what the current income stream was, how he got sold on it. So we'll take a look at that. We won't necessarily penalize them depending on how the forbearance occurred.
Okay, I've got a couple of different questions on fees, which apply and whether they're borrower fees or the we pay them or the borrower pays them.
Well, we have a standard fee that goes along with each one of our loan products, and it depends on the type of product what the fee is. The neat thing is, and Jeff kind of expanded on it, that we offer, a lot of people don't, is we actually can keep you in the same LTV bucket, and you can actually stack the fees on top, which means, in his example, you'll still get your rate at a 70% LTV, even though the true LTV on the loan is at 72%. So I hope that helps. And if not, call your local account executive. You can find out who it is. If you write in an email to us today, we'll get you set up with someone and give you a call and work whatever deals we can with you.
Okay. Can you do more than 750,000 for investor?
Absolutely. I think we've done one all the way up to $1.5 million recently. So yeah, loan size doesn't really bother us. Once again, the higher the loan, though, it gets a little tougher meeting the DSCR. Typically what we see is the larger loan amounts at lower LTVs tend to cover. So just check your DSCR to see how close it is to 1 and give us a shout, tell us the scenario, and we'll see if we can help you out.
Who selects the appraiser? AMC?
I'm sorry, Rose, I didn't hear that. We have an approved list of our AMC appraisers on our company website. However, we do, that's an actually important point. I appreciate someone asking that question. We do use appraisals as long as they were ran through an AMC that were done for other people. We will take those and use those. Obviously, they still need to be reviewed, but that is a big feature that we offer that some other people don't as well.
What if the DCR is below 1? Is there any program that would be applicable?
Well, it depends how far below 1 is and the rest of the deal. So we like to see it at 1. We're not really advertising that we do it below 1. If there's a good reason for it and you have a super strong borrower, I would say at least get it into us so we can see if we can do a pre-qualification for you, and we'll try to get you a quick answer.
Okay. Are Section 8 rents acceptable?
You broke up, Rose. What was that?
Are Section 8 rents acceptable?
Absolutely.
I'm getting a few questions of property types. I'm getting questions on 1 to 4 units, 5 or 6 units. What is our guideline for the number of units?
The maximum number of units that we have on any program is 4 units, and that's pretty much industry standard. Anything over 4 units is deemed commercial.
Okay, and then fees. One second. Okay, sorry. What are your underwriting turn times for these loans?
How are you guys doing?
That's a good question. Oh, hang on, I'm getting a little background noise. A good question. Underwriting turn times, I'll tell you this, the underwriters that work for me, they love these loans because they're a lot easier to underwrite. So they're generally a little quicker anyway. We're normally 24 to 48 hours. Most of the stuff right now is going out at 24. We do have some capacities to do a rush. If you have a purchase that you're potentially losing, let us know so we can try to make sure we meet your COE times.
Okay, does the applicant have to own a primary residence, or can they live with family?
That question was just asked. We take a look at those kind of closely. The guidelines say you're supposed to have a primary. Once again, our biggest concern on there, we have to make sure it's a non-owner transaction. So that would be a deviation, but we have done them before. We just have to have a firm understanding that it makes sense. And I'll give you an example. Let's say I live in Colorado. I work in Colorado for the phone company, and I live with my parents in the same location, or my parents and us are all in the same house, and I'm buying a non-warrantable condo in Florida. Pretty good indication that that's going to be a non-owner since I live and work in Colorado. So there are those occasions where we'll take a look at that. It's not a definite no.
Okay. Single family business used as ALF, I'm not sure what that is, group home with the proper licensing in place.
That's interesting. I just had a question on that from one of our account executives today. We do homes that are, by exception, that are potentially a group home or a care facility. We really need to have an understanding how long it's been in business. Is it properly licensed? Have there been any modifications to the structure? We usually try to look for a little lower LTV on those. So currently right now too, in the environment we're in, obviously the cash flow is important on those particular properties. So that is not a no either. It's case by case on those type of projects.
Do we lend on mixed use properties?
We had another question on that a little bit earlier. So yes, we do mixed use. We do them on exception. And like I mentioned before, it really depends on the individual property, what percentage of it is commercial. Are we going to be able to get the property appraised on a residential form? Some people have, we've had difficulties before having an appraiser go out and he'll actually state it's more for commercial use. So it really depends on the collateral on that piece and the borrower. So we'll take a look at those on exception.
Awesome. I'm getting a ton of different questions on very specific exceptions. And I'm getting questions on specific scenarios and who is my account executive, etc. So what you can do is go ahead and reply to the thank you email that you're going to get in about an hour, and that'll come to me, Rose Waldy. I'll go ahead and forward your comments and your scenarios, and I will connect you with a regional manager or an account executive who will help you with your specific scenario. So if you're not currently working with a Lehnsherr account executive, if you are, obviously just contact your AE. But if not, go ahead and send me an email and I will be happy to help. It's rwaldy@lehnsure.com. Or you could just reply to that email. With that, I think that is it for questions that are general questions. Do we have any parting words, Jeff? Do you want to say any parting words?
Oh, sure.
Yeah, well, I just have one thing. First,
Okay.
I'd like to thank Jeff and Rose and everyone else for attending today's call. What I'd also like to let you know, too, is that even at our operations manager level and our underwriting level, everyone here at Lehnsherr has 20 years plus experience. We consider service our number one job that we have to provide to you. So we appreciate your business. So I hope you have a good day. Be safe, and thank you.
And Rose, I'll just add that, yeah, thanks everyone for joining the call. I hope we demonstrated that we are a flexible lender. We're here to help you. Yes, reach out to your account executive and we'll definitely take care of you that way. But we just look forward to partnering with you and appreciate the opportunity to service you. So that's what I have. So thank you.
All right. Thank you so much, everyone, for joining us today.
Thank you.